We are in the Asian Pacific Museum in Warsaw, and there's a pretty good reason for that, because we are going to talk about investing in Asian Pacific. I'm with George Efstathopoulos from Fidelity International. Good afternoon.
Good afternoon.
And I want to start with this very place. I want to ask you if the investment spectrum is as versatile as the culture of this huge part of the world.
It's a very interesting museum we are here today, and certainly Asia does have a very diversified investment spectrum. But also, if we touch about sort of Asia today, Asia continues to be the key investment engine growth of the world. The growth rates we have in Asia are higher than the rest of the developed market world. If we also look at demographics, while other populations are aging in places like the US, for instance, and in Europe, Asia still benefits from a relatively younger generation. And the last thing, in terms of politics, Asia today historically has been associated with higher political risk. I would actually argue that today, in places like the US, in the UK, that's where we're seeing higher political risk at a time when political risk in Asia is somewhat more subtle.
I want to ask you about the investment spectrum itself. How it developed during the last, let's say, a decade. Take the example of the bond market. How the bond market has changed during the last
I'd say
decade.
Huge transformation in the bond market, whether we look at the government bond market, the investment grade bond market, or the high yield bond market. Much more depth and breadth of issuance, a lot more ability to diversify one's portfolio. We now have diversification across regions, countries, industries, sectors. And I think interesting as well, if we look at the composition of Asia high yield, for instance, a lot of people don't appreciate that Asia high yield average quality is a little bit better than the US high yield, which is single B+, whereas Asia high yield is double B-. Also, Asia high yield has a lot of less triple Cs compared to the US. And I always think of triple Cs as being the problematic credits of the future, the ones that can drive spread volatility, but also defaults in the future.
How about the liquidity and the depth of the bond market?
The liquidity has certainly been increasing and improving, and I would say the past 5-6 years even more so. Why? Because with the changing demographics, with also Asia now having one of the biggest middle income groups in the world, more than 50% of the middle income group of the world is actually in Asia. That has translated in pension funds, local pension funds, something that Asia hasn't had 10, 20 years ago. And that's important because you have a constant buyer of a lot of these bonds, whether it is government bonds or credit bonds across high yield and investment grade. That has meant a lot more liquidity, but also a lot more stability in these markets.
You live in Hong Kong, actually.
Yes, I do, yeah.
So you see on a daily basis how this region develops. So I want to ask you about the interesting markets you see right now. What's your view on that?
Interesting markets I see right now. Well, to start with, we talked about bonds before. China is opening up its capital markets across the bond side and the equity side. Historically, investors have never really allocated risk to China government bonds. This is an area that we have been very interested in. We have actually been introducing that to a lot of our portfolios. And if I look at last year, China government bonds was the best performing government bond market in the world. It delivered in local currency terms returns of more than 10%, but also in dollar terms or other sort of euro terms, for instance, still better returns than US government bonds or European government bonds. And not only that, not only did they provide decent total returns, when they worked was very important. In Q1 of 2018, US treasuries, so US government bonds were selling off, and at the same time, US equities were selling off. A lot of investors were asking, where do I hide? What assets do I hold to provide negative correlation to my risk? China government bonds is that asset class that really delivered on that premise. Worked very well when everything else was selling off in tandem. So that's definitely one of the areas that we're finding interesting today and have been for the past year or so.
You're also the manager of this fund, Fidelity Asia Pacific Multi-Asset Growth and Income Fund, AP-MAGI.
AP-MAGI, yes.
That's the shortcut. It's a pretty new fund, set 3 years ago. why Fidelity decided? I think you already answered the question, but I want you to elaborate on that. Why Fidelity started this new fund based only on Asian instruments?
The key thing is we think that even in Asia, one can actually build a fairly well-diversified portfolio. On the equity side, you have more defensive equities like ASEAN, for instance, Southeast Asia, places like Indonesia, Malaysia, Thailand. These are more domestically focused economies and equity markets that actually tend to do better during risk off, and they tend to do better when markets sell off. They did better in 2018 versus the rest of the region. But at the same time, as I mentioned, China government bonds providing sort of this balance to the rest of the portfolio. So we thought that we can deliver and create a strategy just in Asia that essentially provides the Asia growth story, so delivering Asia equity-like returns, but with much lower volatility and lower drawdowns, which, as far as I understand, is one element that investors globally have always been somewhat concerned about, risk in Asia.
I want to talk about more this volatility thing and drawdowns, because how do you reconcile one with the other, having this fund focused on Asian instruments and on the other hand introducing your clients this strategy that has lower volatility and like you said, there are not so many drawdowns. In investor minds, probably Asia region is considered, pretty much risky. So my question is, how do you reconcile one with the other?
So always trying to make sure
how to have water with fire. Yes.
Water with fire. So I think, first of all, risk. One has to take risk. There are no risk-free returns. There are no risk-free income. So we need to be exposed to risk to make returns in the portfolio. But at the same time, we need to think of what can be the defensive building blocks, the defensive aspects of the portfolio. And I mentioned before, China government bonds, the only government bond market last year that provided positive returns and negative correlation to risk. We have had a meaningful amount of that allocation in the portfolio that has helped during times of drawdown. But I would also say Asia high yield, yes, it is a volatile market. It's probably more volatile than its other regional counterparts like European high yield and US high yield. But actually, second half of last year, Asia high yield was a lot more resilient than European or US high yield. And if we look at Q4 of 2018, this is when most markets came under stress. Chinese equities, Asian equities, US credit, US high yield, all markets sold off in Q4. Asia high yield, on the other hand, was flat during that period. And we did build a very meaningful allocation to Asia high yield in the second half of the year because we got a lot more comfortable with the fundamentals, the valuations were very attractive, and the one key missing piece of the puzzle was liquidity. And with China somewhat reverting from deleveraging and moving from off-balance sheet to on-balance sheet, that had somewhat put a pressure on liquidity for sort of private companies. That started changing, and that actually created very interesting and good dynamics for Asia high yield to first be resilient, and so far, year to date, it's the best performing of all the high yield markets globally.
Mm-hmm. So the AP Magi is a multi-asset fund. So let's talk about the assets. Equities, bonds, but alternative investments. Could you say something more about the alternative part of the fund?
We do have an allocation to alternatives. We always have to ask ourselves, what is the role of alternatives? Why should one invest in alternatives? And essentially, they bring low correlation to all the other assets that we have. Low correlation means a more balanced portfolio, and at the same time, it provides also a diversified income stream. This is the key reason we have alternatives in this portfolio and all our portfolios, to be honest. And they deliver exactly on that premise. Low correlation to all the other asset classes, and as a result, a more balanced, a smoother journey for our clients' portfolios, for our clients' investments.
Mm-hmm. But to be precise, what are actually these alternative investments? Could you name them?
Yeah, so these alternative investments range from loans and CLOs, which are floating rate in nature, very good investments during a rate normalization period. They have delivered exactly on that premise in the past couple of years. Infrastructure, economic infrastructure and social infrastructure, and other areas like sort of mortgage investing or asset leasing, So a plethora, a variety, wide variety of alternatives, over 25 alternatives in the portfolio today, which again, a lot of idiosyncratic risk, they do different things at different times, and exactly that's what we're after from these investments.
I'm wondering, how do you play with the allocation in the fund? Let's take, for example, trade war
Yes.
between US and China. How the portfolio changed, or did it change, before and after the trade war began a year ago?
So before even trade was sort of started hitting the news channels, we had actually already started de-risking the portfolio because we were seeing elements of slowdown in especially China, and China does drive global growth levels. So we had already started de-risking some of the portfolios. So when trade wars started happening, we had much lower exposure to equity risk. Now, I would actually argue that trade wars created very negative sentiment for the Asia region and Chinese
You would
equity.
argue that
I would argue that the biggest, so last year, let's look at last year. Last year, what happened in Chinese equities? Very strong earnings growth, so double-digit earnings growth, but multiples compressed by 30 to 35%. So PE ratios compressed by 30 to 35%. So fundamentals actually grew good, double-digit earnings growth, but multiples compressing by almost 30 to 35%. This is what trade wars did. Very negative sentiment. From our perspective, as this negative sentiment narrative has somewhat become a little bit better since the beginning of this year, we have actually been adding to Chinese equities, and there's a plethora of reasons why we have added to Chinese equities. First of all, they have actually cheapened on the back of last year's sell-off. Valuations have become a lot more attractive. Earnings growth is still attractive, and it's not just driven by a couple of stocks in a couple of sectors. We are seeing earnings growth coming from all sectors, and the breadth of this earnings growth is very, very attractive. And also, we have seen MSCI inclusion. So Chinese equities are now punching sort of heavier into global indices. And that has happened at a time when overseas investors, global portfolios, are now at one of the lowest weights, a big underweight versus historical allocations to China. Again, at a time when China is occupying more of the indices. And ROE growth. ROE growth is one of the strongest in the region. Why is that? Because China and Chinese equities are still very much benefiting from the Chinese domestic growth story, probably one of the most important themes in this decade.
I wonder if, given what you already said about the region development, would it be possible to open the same fund a decade ago?
A decade ago, you could still have a fund like this, but I would argue that it would have been a lot less diversified and also probably more volatile. Whereas today, again, on the technical side, liquidity, on the fixed income component, that has become, the depth of liquidity is much, much better than it was 10 years ago. If I look at the equity market, corporate governance, dividend-paying culture, more than 98% of companies now in Asia pay a dividend. They are returning value back to shareholders via dividends. That is a big change to 10 years ago. That is a very good improvement, which also means lower volatility, more stability, and they're doing so, these dividend payments, they're doing so with lower payout ratios compared to other parts of the world, including Europe and the UK, for instance, and that means higher margin of safety. And if I look at dividend growth, one of the highest growing in the globally, and what drives dividend growth is free cash flow yield. And on that premise as well, Asia is actually growing faster than the rest of the world. So a lot of very good improvement in the past decade. So I would actually argue that today is, and the past 3 years that we've been managing the strategy, it's just about hitting the 3-year track record, and we've delivered equity-like returns, but with much lower volatility and a much better drawdown profile. So very much a good environment today to be looking at Asia standalone.
Thank you very much. I wish you all the best with the fund.